about another history lesson shows why we don't overpay for hot stocks. And I've been doing this for about 45 years now. And it's always made sense to me. And I try to tell people. And the thing is, it doesn't happen in 2 weeks or 3 weeks. We're talking now about a 5-year time frame that this actually showed up. And people thinking, oh, yeah, I'm so smart. Well, let's talk about what we're talking about here. We know it's exciting to be the next hot thing on Wall Street, but that was the same way people felt just a few years ago with hot software companies like Salesforce, Adobe, and ServiceNow. Looking back, many of these once hot companies now have seen very disappointing 5-year returns. As an example, Salesforce is only up around 1% for the last 5 years. And that doesn't mean, too, because if you bought that stock, I'm going to say a year ago, you're actually negative. So we're talking about a 5-year return, just about 1%. But another one here, too, that's over 5 years. Adobe, I was shocked on this. Adobe actually has fallen 35% over the last 5 years. And Adobe was a hot name, like, oh, wow, you can't go wrong with Adobe. Well, 5 years ago, you're down 35%. You've lost a good amount of your money.
Yeah, and the interesting thing is you kind of bring up, the way people kind of view investing in these. And Adobe and CRM or Salesforce, they're both up well over 200% over the 10-year period. Mm-hmm. And so, again, congratulations, I guess, if you bought it 10 years ago. But the problem that many people have is they'll buy it, and they're like, yep, see, I was so smart. I made all this money. And then they put more money to work in it, more money to work in it. And now your incremental kind of investments are underwater. And now your net gain might be neutral or potentially down, depending on when you invested in these names and added additional funds. So, I mean, that's the problem. Or the other big problem is it went way up the first 5 years in that 10-year period. And people are like, oh, wow, I got to get into the hype. And that's exactly what happened. Remember SaaS, right? Software as a service. That was the name. That was what was hot. And then, people pile into it. And now those people that invested 5 years ago, they've done very, very poorly. And the thing we always tell people, we won't overpay for earnings on high-flying companies because many things can change, like we have seen in the software industry. Software companies were supposed to benefit from AI. I remember hearing this 2 years ago, CRM, Salesforce, Adobe, they were going to be big benefactors of it. But now we look at Anthropic's Claude Code as an example. It's an AI tool. It says it can shrink the time it takes to actually build complex software. So, some people are saying, well, I can now use AI to maybe create my own software company. And again, I'm not a tech person, so I don't know the exact mechanics behind this. But I do know, as you said, competition, new entrants here can be problematic. And I think that's what we're seeing. And I did see, I don't know how it works, but on CNBC, they showed, I guess with this Claude, they just typed in Microsoft Excel, build me a analysis for Google or Alphabet, and it went through and had the sensitivity analysis, and that's all you had to put into the Excel spreadsheet, and it produced all of this information. So, I mean, it's pretty impressive what the technology can do there.
And I do remember a couple of years ago, and I don't remember the gentleman's name, that's the CEO of Salesforce, but he was on CNBC talking about, yes, AI, we're going to do this and that, this is going to grow the company, blah, blah, blah. Wow, he must have been surprised now.
Oh, yeah.
Well, also, in addition to that, new competition can come from startup companies that can slowly take away market share of the older companies, and sometimes just a little bit at a time. And before you know it, it's been 2-3 years, they've lost some market share. Unfortunately, some of the software companies began to borrow substantial amounts of money and now have highly leveraged balance sheets, which could cause problems, even more problems in the future for some of these software companies.
And I look at kind of Adobe as an example, and I don't know necessarily everything that Adobe does, but, Canva was actually a new entrant into kind of not necessarily the PDF space, but really kind of creating marketing materials. And that's really where I think a lot of people used to use Adobe. So there was that new entrant there, or an extreme example, right? We've talked about this before, about how hot Intel was. Well, then NVIDIA came along, and they were now the top dog. And the problem is, when somebody's the top dog, like NVIDIA is now, nobody wants to think that somebody else is going to come in and knock them off the throne. But obviously, we see it time and time again in history. And kind of back to your point about the leverage balance sheets, in just the last 24 months, 13 software companies have defaulted on loans. I don't think many of these big software companies, again, Adobe, Salesforce, Workday, I don't think they'll be out of business anytime soon, but I also don't believe their stock will run up to the level seen in the past anytime soon. And I will say some of these companies, Adobe now trades, I think, around 10, 11 times earnings. Pretty darn attractive based off the valuation. like ServiceNow, I think they're still in the 30s. There's still potential growth there, but the valuations on some of these still aren't attractive.
I know when we saw this, we talked about, maybe we should look at software companies. And unfortunately, we didn't pick one for today's show, but maybe next week we should, because maybe there's now some value there. And it won't take us, and see, if you paid, I'm going to say $100 a share, it's now 50, you need 100% return to make that back even. But if we buy it at 50, gosh, we'd be thrilled if it goes to 60. That's a 20% return. We would love to see that type of return.
Oh, absolutely. And one other last point I wanted to make on these software companies, there's a gentleman in Barron's. He was talking about stock-based compensation.
Oh, yeah.
And I loved this point because a lot of times people back out stock-based compensation from earnings, and a lot of these software companies have. So if you're looking at buying these companies, make sure you're looking at that component. And the reason it's so important is because it's not really an expense. You're just issuing shares, and that is dilutive, but that does kind of get accounted for in the long term because the outstanding shares should be rising anyways. But the downside is, with the stock being down 50%, are you gung-ho as an employee about being paid in stock-based compensation? You basically just got a 50% haircut in your compensation. So now what happens is people say, no, I don't want stock-based compensation. I want dollar compensation. Yeah. And then those expenses actually start to flow in now to the income statement. So that is one thing I would be looking at if you hold these software companies. What is that stock-based compensation? Because that could really change earnings over the next few years.
And it's so important to understand these things, because investing, people say, oh, it's easy. It is not easy. You look at all these things, the stock-based compensation, the fundamentals of the company. There's so many things. In short term, anybody can guess, roll the dice. But longer term, you've got to understand you're investing in businesses. You have to understand that business, how it's operating, because it all comes down to eventually the earnings that company is making. And that's why we spend many, many hours, sometimes 10, 15, 20 hours looking at a company before we invest into it, because we don't want to be blindsided like, oh, shoot, we forgot about the stock-based compensation. Now they want cash.
Yeah.
And as you said, what employee would say, give me more of that stock that's going down in value?
And it could make sense, but people don't think that way oftentimes.
No.